Hi, I'm Jim Deloisio, and I'm here to talk to you about taxes. I'm a lawyer. I've been practicing tax law for about 20 years here in the Los Angeles, greater Southern California area. And I've helped a lot of people, believe it or not, help themselves. Somebody said to me, why don't you make a video? So I'm making a video. Hopefully, this will save you a little money and save you a lot of aggravation and heartache in dealing with the IRS. Let's get started. You come home from work, it's a long day, you're looking forward to a quiet evening, a nice dinner. You open your mail and there's a letter from the Internal Revenue Service. Talk about screwing up your day. What do? Okay, here's rule number 1. Open it and read it. Sounds simple. You would be shocked at how many people I've represented that have gotten themselves into trouble because they simply didn't open the letter. They were afraid to read it. Somehow there's this primal part of our brain that thinks if we don't open it, it'll go away. Okay, let me tell you, it doesn't go away. I can promise you with certainty that if you don't open your mail from the Internal Revenue Service, things are going to get worse than they are, however bad they are. It never gets better. So rule number 1, open your mail. I want to talk to you about taxable events. A taxable event is something that you do that creates an obligation to pay a tax. And at some point down the road, maybe you didn't know about it, maybe you underestimated, maybe you forgot. For whatever reason, you didn't pay the tax. Or perhaps you really didn't owe the tax, but you might have. And you're in this funny situation where the IRS is looking at your tax return. They don't know what happened. It looks like you might owe the money, so they send you a letter. This is why you have to open it, because it may be just a phone call to explain what you did, and 10 days later you have another letter stating, thank you, you don't owe us any more money. It could be that simple. Believe me, I've done it hundreds of times. So let's say you owe them a little money because of a taxable event. Let's talk about the 3 most, I don't know if they're the most common, but let's say the 3 most popular taxable events that I see, based upon the inquiries that I get from the general public. There are 3 areas that people want to know about all the time. Number 1, acquisition of property by gift or inheritance. Somebody wants to give me some property. Do I have to pay tax? Somebody left me some property and they died. Do I have to pay tax? I'm selling my house. Do I have to pay tax? Most of these people are dealing with something that's known as the capital gains tax. To understand the capital gains tax, you have to understand the concept of basis. Your basis in the property is generally what you paid for it, plus whatever capital improvements or costs were associated with it. Let's say you're a mechanic, and you go out and you buy some piece of equipment that you need for your business, and this equipment costs $150. You pay 8% sales tax, it was $12. So you paid $162. That's your basis in this property, okay? You buy a house for $100,000. You put a new roof on it, you put in a driveway, you put in a fence, maybe it costs you $25,000. Your basis is now $125,000. You buy some stock. The stock costs you $50,000 over time. Your basis in the stock is $50,000. Okay? So keep that idea in mind. Basis Because here's what's going to happen. Uncle Ed has this stock, and he wants to give it to you. He wants to leave it to you. He spoke with his estate planning attorney, and his estate planning attorney said, well, you can leave this stock to your nephew, Bill. And Uncle Ed went home that day and thought, I don't want Bill to wait. I really like him. I think I'll give it to him now. So Uncle Ed gives you his stock. Uncle Ed paid $15,000 for this stock over a number of years. It has now appreciated to $60,000. When he gives you his stock, in which his basis is $15,000, your basis now becomes $15,000. So if you want to sell that stock for $60,000, you have a capital gain of $45,000. The capital gain tax, assuming that you've held this property for a year, we're talking about a long-term capital gain, something that you've held for a year or more, the tax is 15%. Back up. If you don't own it for a year, it's a short-term gain, and you pay your regular tax rate. You don't really save anything, okay? So my capital gain discussion here talks about capital gains kept on property that you've owned for at least a year. So we've just learned that property that you acquire by gift retains the basis of the donor, the person who gave it to you. Whatever their basis is, your basis is. If you sell it, you have a gain that you pay tax on. Let's change that fact just a little bit. Uncle Ed listens to his lawyer's advice, puts you in the will as a beneficiary, he passes away, and you inherit this stock with the $15,000 basis, and now it's worth $60,000. Your basis is, guess what? $60,000. Your basis is whatever the fair market value of the stock was as of the date of death. It's what is known as a stepped-up basis. So you inherit that stock, and you can sell it the next day, tax-free. 15% of $45,000 is a lot of money, okay? That's the difference between acquiring property by gift versus acquiring property by inheritance. Another question I get, somebody gave me this property, do I have to pay taxes on it? No. The IRS position is it's a privilege to give away money. The donor is taxed. If you want to give somebody something, you pay the tax, not the recipient. When you receive a gift, it's tax-free. So don't worry about the taxes. Now, selling your house, a little bit different. If you sell your house that you've lived in, that you've owned and you've lived in it for at least 2 of the 5 years previous to the sale, and it's been your principal residence for those 2 years, you can exclude up to $250,000 of gain if you're single, and up to $500,000 of gain if you're married. And it could be any 2 of those previous 5 years. Now I see I'm about to run out of time because YouTube has a 10-minute limit on their videos. I'll be back with more cool information in a bit. This is Jim Deloisio of James Deloisio Professional Income Tax Services, Santa Barbara, California. 626-482-2330. Back soon.